Today, the precious metals market shocked the world. Silver collapsed in a way that almost no one expected. In just one day, silver prices fell by nearly 30%. Gold also dropped sharply, losing around 10%. For assets that are usually called safe havens, this kind of move is rare. For silver, it was historic. Many investors woke up confused, others were angry, some were scared. For months, gold and silver had been moving higher. Silver especially looked unstoppable. Prices had doubled over the past year. Headlines talked about shortages, inflation, and the collapse of paper money. Social media was full of posts claiming silver was about to go to the moon. And then suddenly it all changed. To understand why this happened, we need to go back to how silver and gold reached these levels in the first place. This crash did not come out of nowhere. It was the result of several forces building up at the same time. Over the past year, gold and silver were lifted by big macro fears. Investors worried about inflation. They worried about government debt. They worried about the value of the US dollar. Around the world, central banks were buying gold, and that gave many people confidence that precious metals were entering a new era. Gold moved up steadily, but silver moved much faster. Silver always does that. When markets are calm, silver lags behind gold. But when excitement grows, silver often runs ahead. It is smaller, thinner, and more volatile. That makes it attractive to traders looking for quick gains. As prices rose, more people jumped in. Exchange-traded funds, or ETFs, that track silver started to see massive inflows. In some cases, more money was flowing into silver ETFs than into large stock market ETFs. That alone was a warning sign. On financial television, analysts started to notice something unusual. Silver was no longer moving just because of supply and demand. It was moving because of excitement, because of momentum, because people believed it could only go higher. On CNBC, analysts described silver as entering meme investment territory. That phrase matters. A meme investment is not driven by careful analysis. It is driven by emotion, stories, and crowd behavior. Prices rise because people expect prices to rise, and when that belief breaks, the fall can be brutal. At the same time, there was real physical demand coming from Asia. In India and China, buyers were paying unusually high premiums for physical silver. On the surface, this looked bullish. It seemed to confirm the idea that silver was truly scarce, but this demand had a timing problem. In India, the government announced a hike in import duties on precious metals. That change was scheduled to start on February 1st. As a result, many buyers rushed to import silver before the new tax took effect. This pulled future demand into the present. It made current demand look much stronger than it really was. In China, a similar thing happened. Lunar New Year was approaching. Gold and silver are popular gifts during this holiday. Factories also tend to stock up on silver before shutting down for the break. Once again, buying was pushed forward in time. None of this demand was fake, but it was temporary. Under normal conditions, these seasonal buying patterns do not move global prices very much. This time they did, because they arrived at the same moment as heavy speculation in the West. Physical demand in Asia and speculative demand in financial markets combined into one powerful surge. Silver prices kept climbing. Eventually, silver reached levels that were hard to justify. The gold-to-silver ratio fell towards 60, a sign that silver had become very expensive compared to gold. Analysts began warning that the market was stretched. Still, the buying continued. Gold also played a role in pulling silver higher. Gold had spent weeks trading far above its long-term averages. That kind of move is usually not sustainable. Markets need time to breathe. Prices need to consolidate. When that does not happen, the risk of a sharp correction grows. By the time the market reached its peak, silver was priced for perfection. It assumed demand would stay strong everywhere. It assumed inflation fears would only grow. It assumed easy money would continue forever. That was a dangerous assumption. When prices finally started to slip, the reaction was fast. Silver did not drift lower. It fell hard. Traders who were using leverage were forced to sell. ETFs began to see outflows instead of inflows. The same momentum that pushed prices up now worked in reverse. On Fox Business, commentators described the move as the worst percentage drop in silver since records began. Some compared it to the Hunt brothers' collapse of the 1980s, when an attempt to corner the silver market ended in disaster. Gold held up better than silver, but it still suffered a sharp decline. That raised an important question. If gold is a safe haven, why did it fall too? The answer lies in what was happening beneath the surface. Expectations about the US dollar and future monetary policy were shifting. Investors were suddenly rethinking how much inflation protection they really needed right now. This brings us to the final and most important trigger of the sell-off, a shift in expectations around the Federal Reserve and its future leadership. And that is where the story continues. Markets do not move only on facts, they move on what people think will happen next. Sometimes a small change in expectations can move prices more than a big event itself. That is exactly what happened during this sell-off. In the days leading up to the crash, investors began to focus on the future direction of U.S. monetary policy. More specifically, they began talking seriously about the possibility of Kevin Warsh becoming the next chair of the Federal Reserve. Kevin Warsh is not a new name. He served as a Federal Reserve governor in the past and is known for holding strong views about inflation and monetary discipline. Compared to other possible candidates, Warsh is seen as more hawkish. That means he favors tighter financial conditions, less easy money, and a smaller central bank balance sheet. Why does this matter for gold and silver? Gold and silver usually perform best when money is easy. When interest rates are low, when liquidity is high, and when central banks are expanding their balance sheets, precious metals tend to benefit. They are often seen as protection against inflation and currency weakness. But if markets start to believe that the future will bring tighter policy, the story changes. As talk about Kevin Warsh grew, the US dollar began to strengthen. A stronger dollar puts pressure on commodities priced in dollars, including gold and silver. When the dollar rises, metals become more expensive for buyers using other currencies. Demand can slow quickly. This shift hit the market at a fragile moment. Gold had already experienced a very strong rally. Prices had moved far above long-term averages. Many traders were sitting on large profits. Silver, even more so, had become crowded with speculative positions. When expectations shifted, it did not take much to start a wave of selling. Once the selling began, it fed on itself. Traders who bought silver with borrowed money were forced to sell as prices fell. This is known as a margin call. When too many margin calls happen at once, prices can collapse in a very short time. This is not panic selling. It is mechanical selling. Positions are closed whether investors want to sell or not. ETFs added to the pressure. During the run-up, silver ETFs had absorbed massive inflows. When prices turned, those flows reversed. Metal that had been taken off the market was suddenly being sold back into it. This increased supply just as demand was weakening. At the same time, analysts began to speak more openly about silver's underlying fundamentals. On CNBC, analysts from major banks pointed out that silver is likely moving into a physical surplus. That means more silver is expected to be available than needed. Industrial demand, while still important, is not growing fast enough to absorb the extra supply at current prices. This is where silver and gold differ. Gold is mostly a monetary metal. Central banks buy it. Investors hold it as a reserve asset. Its supply grows slowly, and much of the gold ever mined still exists. Silver, on the other hand, is both a monetary and an industrial metal. It is used in electronics, solar panels, and manufacturing. Its demand depends on economic activity. When growth slows or when inventories are already full, demand can fall quickly. That makes silver more volatile. As prices collapsed, reports began to surface of increased physical selling by retail investors. On Fox Business, commentators described Americans selling silverware, old coins, and scrap metal at shops, especially in places like Manhattan's jewelry district. This kind of selling is important because it shows a change in behavior. Just days earlier, many of these same people were buyers. Now they were taking profits or cutting losses. Sentiment had flipped. Gold did not escape the sell-off, but its decline looked different. Analysts described gold's move as a consolidation rather than a collapse. After a very strong and fast rally, prices were pulling back to more sustainable levels. Gold had spent weeks trading far above its 100-day moving average. Historically, that does not last. In that sense, gold's pullback could be seen as healthy. The long-term drivers behind gold had not disappeared. Concerns about inflation, government debt, and global financial stability were still present. Central banks were still holding large amounts of gold. None of that changed overnight. Silver, however, faced a tougher road. With speculative demand fading and physical demand from Asia already satisfied for now, the market had to adjust to reality. Analysts warned that silver could underperform gold going forward. That does not mean silver will never rise again. It means the easy part of the trade is likely over. The lesson here is not that gold and silver are useless assets. The lesson is that no market moves in a straight line. When prices rise too fast, driven by excitement rather than balance, the correction can be sudden and severe. In a single day, silver reminded investors of its true nature. It is powerful, but it is dangerous. It rewards patience, but punishes crowd behavior. And as the dust settles, one question remains. Was this just a violent correction? Or was it the end of a chapter in the precious metals story? After the crash, the market did what it always does. It started asking questions. Was this the end of the metals bull run? Or was it just a reset after prices moved too far, too fast? To answer that, investors began looking closely at the difference between gold and silver. Even though they often move together, they are not the same asset. And during this sell-off, that difference became very clear. Gold is treated as money. Central banks hold it. Governments store it. Investors use it as insurance against crisis. When people lose trust in currencies or financial systems, gold is often where they turn. That gives gold a kind of support that few other assets have. Silver does not have that same support. Silver is part money, part industrial metal. Its price depends not only on fear and inflation, but also on factories, production cycles, and real economic demand. When growth slows or inventories build up, silver can struggle even if gold remains strong. This is why analysts expect silver to underperform gold after the crash. On Kitco, market strategists explained that much of silver's recent demand had already been satisfied. Industrial buyers stocked up early, seasonal demand passed, ETF investors pulled back, that leaves the market searching for a new base. Gold's situation looks different. Gold prices pulled back sharply, but many analysts describe this move as a pause, not a breakdown. After a powerful rally, markets often need time to cool off, prices consolidate, weak hands exit, stronger holders remain. In that sense, gold may be doing exactly what a healthy market does. Another factor investors began watching closely was the gold to silver ratio. This ratio shows how many ounces of silver it takes to buy 1 ounce of gold. When silver is very strong, the ratio falls. When silver is weak, the ratio rises. Before the crash, the ratio had dropped toward levels that suggested silver was expensive. After the sell-off, the ratio moved higher again. That shift supports the idea that silver had run ahead of itself. As the market stabilized, attention turned back to fundamentals. For gold, those fundamentals still exist. Inflation concerns may rise and fall, but government debt remains high. Geopolitical tensions have not disappeared. Central banks, especially outside the United States, continue to see gold as a long-term reserve. That does not mean gold will rise every month or every year, but it does mean gold still has a role in the global system. Silver's role is more complicated. Industrial demand for silver remains important, especially in areas like electronics and solar energy. But that demand grows in cycles. It does not move in straight lines. When prices spike too quickly, buyers often step back and wait. This waiting period can last longer than investors expect. That is why many analysts warned against confusing short-term excitement with long-term value. During the run-up, stories about silver shortages spread rapidly online. Some of those stories were exaggerated. Others ignored timing and inventory levels. When reality returned, the adjustment was harsh. On barons, analysts emphasized that markets do not punish optimism, they punish imbalance. When too many people crowd into the same trade at the same time, even good assets can fall sharply. This is especially true in smaller markets like silver. Another lesson from the crash involves liquidity. When markets are calm, liquidity feels endless. Buyers and sellers meet easily. Prices move smoothly, but during stress, liquidity can disappear. Orders dry up. Small moves become big moves. This is what turns a correction into a collapse. Silver experienced that firsthand. As liquidity vanished, prices dropped faster than many expected. Stops were triggered. Positions were closed. What began as a pullback became a historic fall. Gold, with its deeper and more global market, absorbed the shock better. As days passed, volatility remained high. Investors became cautious. Many shifted their focus away from quick gains and back toward risk management. This is often what happens after a major shakeout. The market does not immediately return to excitement. It enters a phase of reflection. Some investors decided to stay away from silver for now. Others began looking for signs of stabilization. Volume, volatility, and price behavior became more important than headlines. Gold investors watched a different set of signals. They looked at central bank activity. They watched the US dollar. They paid attention to interest rate expectations. Gold's future, more than silver's, remained tied to big macro forces. By this point, one thing was clear. The crash was not random. It was the result of stretched prices, crowded trades, shifting expectations, and a sudden return to discipline. It reminded everyone that even assets with strong stories can fall when too much optimism builds too quickly. In the next part, we will look ahead. What could bring stability back to the metals market? What risks still remain? And what lessons should investors take from one of the most dramatic silver crashes in history? As the dust settles, markets begin to slow down. After a violent move like this, investors stop reacting and start thinking. The noise fades. The headlines move on. What remains is a simple question. What happens next? To answer that, we need to step back and look at the bigger picture, not just the crash itself, but what it revealed about gold, silver, and how markets really work. First, let's talk about silver. Silver's crash was not just about one bad day. It was the result of months of pressure building quietly in the background. Prices moved faster than fundamentals. Speculation replaced balance. When that happens, the market becomes fragile. Once the selling began, silver had very little support. Physical demand from Asia had already been satisfied earlier than usual. Industrial buyers had stocked up. Retail investors in the West were no longer buying aggressively. ETF flows reversed. All of this meant that when prices fell, there were not enough buyers stepping in to slow the fall. This is why analysts now expect silver to struggle in the short term. That does not mean silver is finished forever. It means the market needs time. Time to absorb excess supply, time for emotions to cool, time for prices to reconnect with real demand. Silver is a metal of extremes. It rises fast, it falls fast, Anyone who invests in silver must understand that volatility is part of the deal. Gold tells a different story. Gold fell sharply, but its decline looked more controlled. There was no panic, no sense that the entire thesis had broken. Instead, gold appeared to be doing what it often does after a strong rally. It paused. Gold had spent weeks far above its long-term averages. That kind of move almost always leads to a pullback. When prices cool off, it does not mean the long-term reasons for owning gold disappear. It simply means the market is resetting. Many of those long-term reasons are still in place. Government debt remains high across the world. Inflation may rise and fall, but concerns about currency value have not vanished. Central banks continue to diversify reserves. Global uncertainty has not gone away. This is why many analysts believe gold is consolidating, not collapsing. On CNBC, several commentators described the move as a healthy correction rather than the end of a trend. Markets that never pull back become dangerous. Markets that reset can survive. Another important lesson from this crash is about expectations. Prices do not move on what is happening today. They move on what people believe will happen tomorrow. In this case, expectations around interest rates, the US dollar, and future monetary policy shifted quickly. Even a change in tone can matter. When investors began to believe that money might become tighter instead of looser, the appeal of precious metals weakened. That shift did not need to be confirmed by action. The belief alone was enough to move prices. This is why markets can feel unpredictable. They are always looking ahead. The crash also revealed the power of leverage. Many traders were not just buying silver, they were borrowing money to buy it. When prices dropped, those borrowed positions became a problem. Forced selling took over. This kind of selling does not wait for better prices, it sells immediately. That is how small declines turn into large ones. For long-term investors, this is an important reminder. Leverage magnifies gains, but it also magnifies losses. In volatile markets like silver, leverage can be especially dangerous. Another lesson is about stories. During the run-up, silver was surrounded by powerful stories. Shortages, inflation, currency collapse. These stories were not completely false, but they were incomplete. They ignored timing, they ignored price. They ignored the fact that markets can move too far, too fast. When everyone believes the same story, risk increases. Markets need disagreement to stay healthy. Buyers and sellers must both exist. When one side disappears, balance is lost. The silver crash was a lesson in what happens when balance breaks. Now, the focus shifts to the future. Investors will be watching several key things. They will watch the US dollar. If the dollar remains strong, metals may stay under pressure. If the dollar weakens, gold could regain momentum. They will watch interest rates and central bank signals. Any hint of easier money could support gold. Any sign of tighter policy could weigh on both gold and silver. They will watch physical demand. Not panic buying, but steady, real demand. This matters more than headlines. They will also watch volatility. Calm markets suggest stability. Wild swings suggest uncertainty is still high. For silver, the path forward is likely uneven. Prices may bounce, they may fall again. This is normal after a major shock. What matters is whether the market can form a base. For gold, the outlook appears steadier. It may take time, but gold often finds strength when fear returns quietly, not loudly. The biggest takeaway from this event is not about metals alone, it is about how markets behave. Markets reward patience, discipline, and humility. They punish crowd behavior, overconfidence, and the belief that something cannot go down. Even assets called safe havens are not immune to corrections. Silver's historic crash was painful, but it was also honest. It stripped away hype and forced reality back into the price. Gold's pullback reminded investors that strength does not mean straight lines upward. In the end, this was not the death of precious metals. It was a reminder that every market has cycles, a reminder that stories must be tested against facts, a reminder that risk never disappears, it only hides. And for investors watching closely, this moment may become one of clarity, because when markets stop shouting, they start teaching. And the lesson from this crash is simple. Understanding beats excitement, balance beats belief, and in the long run, reality always returns.